Hello and welcome to my new lecture on investment analysis and portfolio management. This lecture is based on the book written by Frank Carelli and Keith C. Brown. Today we are going to discuss chapter number 4 of this book. Chapter number 4 is about organization and functioning of security markets. Uh, Before going ahead, by the end of this presentation, you should be able to answer some questions which are given below. What is the purpose and functioning of a market? What are the characteristics that determine the quality of a market? What is the difference between a primary and secondary capital market, and how do these markets support each other? What are the major types of orders available to investors? And lastly, how to determine profit or loss and the rate of return on different transactions that you make in the market. The first and foremost important question is, what is a market itself? So, market is a mechanism or a medium through which transactions take place. It's the medium or mechanism through which buyers and sellers comes together come together and make the transactions. So that market brings buyers and sellers together to add in the transfer of goods and services. It does not require a physical location, which means that market does not necessarily require a physical location. Market is possible without having a physical location. So therefore it's a platform, or it's a mechanism or a medium through which buyers and sellers interact with each other. Now, market can have physical location, but physical location is not the requirement of a market. Markets are possible without having a physical location even. Both buyers and seller benefit from the market. That, when there is a market, when there are more buyers and sellers, so both parties, they get advantage of a market, because a buyer can have many sellers there, and similarly a seller can have many buyers, and it brings the cost of buying and selling lower, or it reduces the cost. Similarly, it has more liquidity as well. The characteristics of a good market, what are the characteristics? Remember that market does not necessarily require a physical location. So then what makes a market as a good market? So there are certain characteristics. The first one is availability of past transaction information. It means that a good market is the one in which you can get the historical data, so that what happened yesterday, what happened a month earlier, that data should be available. So we are more concerned with the financial markets. So you should know that at what price the security was trading, what was the volume. So this historical data should be available, and that data must be timely and accurate. So timely and accuracy is obviously a characteristic of data. The second one is, a good market is the one which has more liquidity. Liquidity mean that whatever you want to buy or sell, it is available, you can sell it easily. It means that there are more buyers and sellers. The second point related to this, that is what we call as marketability, mean that there is a market for everything. You can buy or sell anything you want. The next thing is that there is a price continuity. The price from one transaction to the other transaction is not changing by a larger percentage. That's what you call as price continuity, and that is possible when there are more buyers and sellers. And the last thing is that there is a depth in the market, that the market has more options available to you, that whatever type of securities you want to buy, those types of securities are available. So mean when there are more buyers and sellers, there are more alternatives. This will make the market as a liquid market. There will be marketability for every type of security, and there will be price continuity. The prices will not be changing by a huge percentage from one transaction to the other transaction. The next good characteristic is that it should have low transaction cost, that the commission that the buyers and the sellers are being charged, those transaction costs are lower, and those are possible when there is more competition, there are more buyers and sellers available. So therefore the transaction cost is lower. So a good market is the one in which the transaction cost is lower. Remember, the transaction cost is the cost that you pay other than the price of the goods and services. Mean, for the price of the security, the the commission that you pay on it, that is what you call as the cost of transaction. So this is known as the internal efficiency of a market. Mean, a market which has lower transaction cost is considered as that the market has internal efficiency. And next one is that the prices of the securities traded there, they adjust quickly or rapidly to the arrival of new information. So whenever there is some news, there is some good news or a bad news, so the prices of securities adjust quickly. That is what you call as external efficiency. It means that the markets represent all the available information, and whenever some new information is produced, it become available public, the prices quickly adjust to that information. The next one that we are going to discuss is the types of markets. So what is a primary market? Primary market, a market where new securities are sold and the funds go to the issuing entity or unit. So generally we say that primary markets are used for generating capital by the organizations. Corporations, companies generate capital by issuing their new securities, and from that transaction the capital flow to the issuing entity. While in the secondary market is a market where outstanding securities, mean where already issued securities are being purchased, sold and purchased by investors. So this is a kind of market in which the fund will not flow to the issuing entity, rather it will change hands. If one person has the security, that person sell the security to another individual, so the capital will flow to the first individual and the funds will not flow to the uh, issuing entity. The issuing unit or entity does not receive any funds in a secondary market transaction, because it is among the investors now the trading is taking place. However, it has its own importance. The secondary market has its own importance for the corporations. We will discuss it later. Okay, so the corporate stock issues can be divided into new issues can be divided into two major groups. The first one is known as seasoned new, or we call in Pakistan we call it as right issues. Mean, these are the shares offered by firms that already have stocks outstanding. Mean, a company which has already issued its stock previously, now if the company is issuing additional stock, so those stocks are known as seasoned new issues, or they are known as right issues. While a company or a firm which is offering its securities for the very first time, that means the company has not a history of having its shares outstanding, so then this is known as initial public offering, a firm selling its common stock to the public for the first time. Remember, both these issues, they are known as primary issues. These are known as primary issues. So the capital will flow to the issuing entity. These are the primary market transactions. But how they are different? In the initial public offering case, it is for the very first time when the firm is offering its securities. While in the season new issues are in the right issues, the company has already issued, has its own outstanding shares, but now the company needs some more capital and therefore the company is issuing new shares. Okay, so whenever the company or the firm is issuing new securities, it requires the services of underwriters. So the investment bankers generally provide the underwriting services. The investment bankers purchase the entire issue from the issuer, the entity, and resell the security to the investing public, to the investors. So companies, they want to generate capital, so what they do is they sell their stocks, their, it can be bonds as well, but here we are talking about stocks. They sell the stocks to the investment bankers, which they are known as underwriters, and then the investment bankers are selling those stocks to the general public. Generally it is like that. The firm charges a commission for providing this services, mean the underwriters generally, how they earn profit in it, that they purchase the securities at a lower price and then they sell it to a higher, at a higher price to the general public, and for that they are earning that commission. However, these relationships are determined, and there are different types of these relationships. The first one is known as negotiated relationship. When the underwriter, the investment banks provide all the services, it is the most common form of underwriting services. It's a full services of underwriting that they actually facilitate or uh, help out the issuing entity in determining the price of the security, the number of securities that they should offer, and what are the possible avenues where they can sell their stocks. So the entire services are being provided. So it is the most common one, and there is a full services of underwriting being provided by these investment bankers. The second one is known as the competitive bids. In the competitive bids, the corporation, the issuing entity only specify the securities that they want to offer, and then the underwriters, the investment bankers, compete with each other to purchase those securities from them, and then they will resell it to the general public. So where the lower cost will result, because whoever is offering the best price to the issuing entity will sell the stocks or the securities to them, and then those companies will, these underwriters, the banks, the investment banks will resell them. This reduces the services of underwriter, because that they are not providing the advice on the pricing or the quantity or the buyers, because they are actually competing. So uh, whoever is offering the best price to the issuing entity will sell it to that particular underwriter, or you can say the investment bank, and then the investment bank will be selling it. And last one is known as the best effort services. In this case, the investment banker acts as a broker. How? That they are actually will only facilitate the buying and selling process, that they are not actually purchasing the securities from the issuing entity, rather they are just helping them out, the buyers, and whatever number of securities will be sold out, they'll charge a commission for that, and the unsold amount of securities will be returned back. Remember, in the competitive bids, the entire issue will be purchased by the investment bank, and even if they are unable to resell it to the general public, they'll bear the cost. While in the best effort basis, they will only facilitate uh, the selling of their securities, but the unsold securities will be returned back to the issuing entity in case if they are unable to sell the securities. Now here comes the question, that if the secondary market is not generating capital for the entities or the corporations, so then what is the importance of the secondary financial markets for them? So here is the point. It provides liquidity to the investor who acquires securities in the primary market. In the primary market, if you purchase the securities, so there should be a secondary market in which you can sell them if you need. So this secondary market provide liquidity to the investors who purchase the stocks or the securities in the primary market. Now this liquidity, it results in the lower required returns than if issues had to be compensated for lower liquidity. So if there is no liquidity for the securities, in the form of secondary market, so the investor will not pay a good price or a high price in the primary market, because in their illiquidity has its own cost. So the liquidity of secondary market actually reduces the cost of investor, So therefore the required rate of return reduces and it become easy to purchase these securities in the primary market. And it also helps the issuing entity to determine the current price of its securities. So when they'll be offering right issues or seasoned new offering, so at what price they'll be selling those stocks or those securities. So the secondary market actually determines the price, the current market price. So when the issuing entity will issue new securities or offer additional securities, this secondary market will be used as a tool through which they can determine the price of the new issue that they want to generate additional capital. That's why financial markets are very important. Secondary markets, equity markets, the most common one, the major, stock exchanges in the world. There are New York Stock Exchange of US, Tokyo Stock Exchange in Japan, the London Stock Exchange in UK. These are the well-known stock exchanges. There are many more. So I'm not explaining everything, all the those secondary market. In Pakistan, we have Pakistan Stock Exchange. So the secondary market for the equities that we have. Then there are some regional stock exchanges as well. These are, the first category is of national level, and then there are regional stock exchanges as well. Mean just like in US there are Chicago, San Francisco. There are, different in Japan, and in so many other countries you can have uh, local, or you can say regional stock exchanges. In Pakistan we used to have Lahore Stock Exchange and Islamabad Stock Exchange, but now these markets have been merged together, and there used to be three markets, Karachi Stock Exchange, Lahore Stock Exchange, and Islamabad Stock Exchange. But now all these three been merged together, and we know this one now as Pakistan Stock Exchange. And then there is an over the counter market. Over the counter market is the one in which stocks are not listed on the organized stock exchanges, just like in Pakistan Stock Exchange or New York Stock Exchange. So these are the markets which is known as, they are known as dealer markets, and they are not organized as such. They are over the counter market, mean through telephone network and kind of things, buying and selling can take place. The well known over the counter market in the world is Nasdaq, the US market. Okay, the trading system in the stock exchanges, uh, there can be pure auction market. Pure auction market is that where buyers and sellers are matched by a broker at a certain location or a platform. Mean just like in the Pakistan Stock Exchange that we are doing, that the buyers and sellers are bring together, and when their prices are matched, the buyers and seller prices are matched, the transaction actually take place. These markets are known as price driven market. Mean these markets are actually driven by the prices, the buying and selling prices. So whenever there is a match occur between the buyers and seller, the transactions take place. The next one there, that is known as a dealer market. Dealer market is the one in which the dealers provide liquidity by buying and selling shares. Remember, brokers are the one who are not buying and selling securities for their own account. They are only matching the prices of the buyer, the actual investors who want to buy and investor who want to sell. So they provide the services of matching their orders or prices, and they charge a commission for that. Dealers on the other hand, they are the ones who can buy for their own account, and let's suppose if there are buyers but there is no seller, then they become sellers. So dealers provide liquidity by buying and selling shares. So dealers may compete against each other. Mean if there is someone who want to sell the stock, so there may be many dealers, and who want, whoever will be offering the higher price, they'll purchase it. Similarly, if there is a buyer who want to buy certain stock, so these dealers will provide the prices at which they are willing to sell. So dealers are actually buying and selling for their own account. Next one is a call market, or a continuous market versus a continuous market. So a call market, it's a market that trade individual stocks at a specified time, uh, when they gather all the orders and then determine a single price on which most of the orders can be satisfied. Mean, so the entire transaction will take place only at a particular point of time for a specific stock. On the other hand, a continuous market is the one in which transaction can take place in any point of time when the market is open. So when the market is open, so you can purchase a stock of OGDCL or PDCL or Lucky Cement or Digihan Cement any time when the stock market is open. So whenever there will be a match between the buying and selling prices, the transaction can take place. In call market, actually the buying and selling orders are gathered, and then at a one specific point of time they determine the price. People, they give their order that how much quantity they want to buy, at what price they want to buy. Then on the other hand, there are a seller who want to sell a particular quantity of security and the price at which they want to sell. All the orders are combined together, and then they determine a single price on which most of the orders can be satisfied. That is what we call as a call market. In a continuous market, the transactions can take place at any point of time whenever there is a match between the buying and selling. Remember, Pakistan Stock Exchange is a continuous market when open. So whenever the stock exchange is open, so at any point of time you can buy or sell stock. Okay, the next important point is regarding the exchange membership. Now, remember that the information technology has changed so many of the things. So now these things are now being reduced, but historically there used to be specialists. We will discuss it on the next slide, that who are specialists. The next one, they are commission broker, the most common membership on the stock exchange. They are known as commission brokers. That these are the individual who are member employees of a member firm, the brokerage firm, who buy or sell securities for the customers of a firm. So there are many brokerage firms in Pakistan Stock Exchange. You can have Jahangir Siddiqui, you can have AKD Securities, you can have Askari Securities. These are the brokers who are buying and selling. So you become the client of the one of these brokerage house, and then these brokerage houses are providing you the facility of buying and selling stocks, and for that they are actually charging a commission. Floor broker, they used to be there, that they are independent members of the stock exchange who can act as broker for the members. It used to be. Now I cannot explain it here, but the point is that there was no information technology, so there used to be individual who used to move freely on the floor of the stock exchange, and whenever there is a relatively more order being placed with a particular broker, and they are unable to meet the transactions, so they used to you can say give the order to the floor broker to satisfy those orders to come. And they are used to be in US, they used to be called as the dollar two brokers that used to charge a little amount of commission for their services. So they are independent, they can work for any of the brokerage firm. The next one, they are known as registered traders, the one who can use their membership to buy stocks for their own account. Remember that brokers, the commission brokers, they are not allowed to buy or sell stock for their own account, while registered traders are the one who are allowed to buy and sell stocks for their own account. They save the commission charges, but then obviously they provide liquidity to the market. Now here comes the specialist and an exchange member assigned to handle a particular stocks. Some particular stock mean, uh, if nobody is willing to buy or sell stock in a particular stock, so there should be a specialist at least, that this person should be ready every time to buy or sell. It should have a bid price and an offer price. So they used to be known as specialists, that they are specialists for these particular stocks. There are certain stocks which can be purchased and sold by every broker, just like, on the other hand, there will be specialists who only specialize in certain stocks. So if nobody else is ready to buy or sell that particular stock, the specialist should have a bid and ask price available every time. It has two roles. Number one, that they are having the broker role as to match the buyers and seller, uh, anyone who want to buy and anyone who want to sell. So they are providing the services as brokers, but on the other hand they are providing services of dealer. It means that if there is a someone who want to sell a particular stock, but then there is no buyer available, so then these specialists, to whom that particular stock is assigned, should have a purchase price for that. So it means that the dealer, as a dealer, they maintain a fair and orderly market, because it does not mean that there is no buyer available. On the other hand, if somebody want to purchase a particular stock, so then, and nobody want to sell that particular stock, so then these specialists should have uh, a sale order that they can sell their stock. Specialist has two income sources. Number one, as broker commission, and there is no risk involved, because they are buying and selling for others. They are not buying and selling for their own self, so that income is without risk. On the other hand, as a dealer, because then in the dealer role, that they are buying and selling the stock for their own account, so they can earn income by purchasing at a lower price and selling at a higher price. That there is a spread between the bid price and the ask price, and that spread is actually an income. But there is a risk involved. Let's suppose you purchase and then you could not find any other buyer, while after a certain time period the prices of that particular stock reduces, so then there will be loss as well. So there is a risk involved. While in the brokerage commission, there is no risk involved, because you are not becoming the owner of the stock, you are just facilitating the buying and selling. Now, the next important point is topic of this chapter or this presentation is the types of orders. Remember, in the stock exchanges, uh, you can tell the broker that when you want to buy, at what price you want to buy, how much quantity you want to buy. So that is they are known as the types of orders. The most common one, that is known as the market orders, the market buy order or the market sell order. So when an investor is willing to trade at the best available price in the market currently, whatever best price is available. Remember, as a buyer, the best price will be the lowest ask price for you. As a seller, the best price is the highest bid price available in the market. So the market buy order or a market sell order, you are actually, when you say that it's a market order and I want to purchase 500 stock of a particular company, it means you want to buy at the lowest ask price available in the market. So the broker will match the lowest price. Now remember, if there are only 300 securities available at a particular price, the next 200 will be purchased in the next best price available. The advantage of market order is that it has liquidity, because whenever you will send this order to the market, so this will be executed at whatever price the stock is available. So there is the market buy order and the market sell order. So in the market sell order, you are ready to sell your stock at the highest bid price available in the market. In the market buy order, you are willing to buy at the lowest ask price available in the market. The next type is known as the limit orders. Limit orders in which you specify the price at which you want to trade. In the market order, you just you provide two things: which stock you want to buy or sell, or how much quantity you want to buy or sell, and the price will be the price available in the market. So you don't specify the price in the limit order. Along with the company, the firm of which stocks you want to buy or sell, the quantity, how many numbers of stocks or shares you want to buy or sell, you can also specify the price at which you want to trade. So the order specify the buy or sell price along with the volume, and obviously with the company, which company you want to buy or sell. These limit orders can be uh, limit to a certain time, that during time period as well. So the time specification for an order may vary from, it's a instantaneous offer, that fill or kill. What does it mean? That you, if the order is possible to be meet immediately, you can execute my order, otherwise you kill my order. If you could not purchase the order immediately, it means my order is killed. It can be for a part of a day, mean that let's say from 10 o'clock to 12 o'clock, if it is possible, you trade my stock at this price. Otherwise, after 12 o'clock, don't trade. My order will be cancelled. It can be for a full day. You place the order at 10 o'clock and until the market is closed. Now, it can be for several days or a week or a month, and the last one is it can be good till cancel. Mean until and unless I cancel this order, my order will still be valid. So whenever the price will come to that level, you can purchase or you can sell that stock for me. Remember, in the Pakistan Stock Exchange, the limit orders are only valid for a trading session. So once the trading session is over, all the limits orders are being cancelled. The next one is short sale. Now, very interesting in the stock exchanges that short sale is sale before purchase. Mean, you know, normally we cannot sell something which we don't own, we don't have. We purchase something first and then later on we can sell it. In stock exchanges, it's possible that you sell the stock first and you will later on repurchase it. So whenever an investor think that a particular stock is going to decrease in price in the future, so it means that that stock is currently overvalued. Mean it is expected that the price will go down, the stock price will go down in the near future. So what they'll do, and let's say you don't have the stock. If you have the stock, obviously you will sell it because the prices are going down. And if you don't have, the other possibility is don't purchase it. But investors, when they get information that a particular stock is going to decrease in price, what they do is, and you don't have it, remember, you don't have that stock. So what you do is you short sell it. You short sell it. Short sell it mean what? You don't have the stock. Through your broker, you will borrow the stock from someone else and you will sell it. And once the price will reduce later on, you will repurchase it. And the difference between the two, you will earn as a profit. That is what we call as short sale. So short seller, they earn profit when stock prices are decreasing. And long position, on the other hand, we call it as long position. You earn profit when stock price increases. You purchase first, and when the price increases, you will sell it and you will earn profit. In the short sale, you sell first, and then once the price reduces, you repurchase it. So you will earn profit from the decreasing prices. So the point is that your broker, you just borrow the stock from another investor through your broker and can only, okay, and then you can sell it obviously. Remember, but there are certain restrictions on the short sale. The first point is that it is only possible on an uptick price, and it should be a uptick trade. I can explain it, but the point is that if the price is in a reducing trend, you cannot reduce the price further and sell. It means that I'm taking the whole values. Let's say the last trading price was 40 rupees, the next trading price was 39.5 rupees. So now if you want to short sell, you cannot put a price of 39. That will be down tick. It means that the price should be equal to 39.5 or above 39.5. That is what you call as uptick. The reason behind this is that investors should not be allowed to artificially crash the market, that you start decreasing the prices and you want to sell more and more stocks, so obviously the market will crash. So to avoid that short sale is only allowed on the uptick price. That's why we call it as it's an uptick trade. The next important point is that if you borrow the stock from another investor and you sell it, but let's say during that time the company announced a dividend, so obviously the one who purchased the stock will get the dividend, but from one that the person from which you have borrowed the dividend, the stock, how that person will get the dividend. So let's say after 10 days you repurchase the stock and you give it back to the investor from which you borrow, so obviously that person has missed the dividend. So then as an short seller, you have to pay the dividend to that person as well. So it says that you must pay any dividends to the lenders from the one who lend the stock to you. And then the next one is, we will understand what is margin transaction. So once you will understand the margin, then you will also understand that there should be a margin deposited in the short sale as well. These are the three requirements. The next one, that is known as special orders. Special orders, the first one is what we known as market if touch order. That the first example is stop loss order. What does it mean? Stop loss order mean that you purchase a particular stock at 50 rupees, anticipating that the price will go up from 50 to, let's say, 55 or 60 or 70, but unfortunately you are wrong and the stock price start decreasing from 50 to, let's say, 45 and start decreasing further. So then investor want to limit their loss, and they may say that, let's say, sell my stock at a price of 40. Remember that currently the stock is trading at a price of probably 47, 48, and you are placing an order that sell my stock at price of 40, but not right now. This is what we call as market if touch mean that if the market price drop down to 40, then sell my stock at that time, so that my loss is limited to 10 rupees. You purchase the stock at 50 anticipating that it will increase in value, but you are wrong and the stock price start decreasing. So how much loss you want to bear? So that is, let's say you say that I don't want to have a loss of more than 10 rupees on this stock, so you will put a stop loss order at 40 rupees. So once the market will touch 40, your order will become active, and then it will become a market order and it will be traded in the market. So it's a conditional order to sell stocks if it drops to a given price. Investor who purchases stock may want to limit loss if stock decreases in price. As I told you that from 50 the price drop down to 40, so you want to limit your loss to 10 rupees. It remember that it does not guarantee the price you will get upon the sale, because the 40, you said that my stock should be sold at 40, but once it touch 40, so then it will be in the queue, and once your turn will come, then your order will be executed. So probably the price may be even less than 40 rupees, but at 40 it will become active, and this will become a market order. On the other hand, there is a stop buy order. It is the case of short sale. So when you have short sale of particular stock, so when the price will start increasing, obviously you will be incurring loss. So in that case, you are ready to purchase a stock. Remember, you purchase it at 50, you short sell the stock at 50. You were thinking, now in this case you were thinking that the price will drop down to 40 or 35 and I'll repurchase. But let's say you were wrong and the stock start increasing in price. You sold it 50 and now the price has increased to 55. So if you repurchase, you will repurchase it 55. If the price increased to 60, you will repurchase it 60. So it means you will incur a loss of 10 rupees and plus the commission charges addition to that. So again, in this case, if you want to limit your loss, so you will put a conditional sale order, which we call as stop buy order. Conditional order to buy stocks if it increases to a given price. Investor who sold a security short may want to limit loss if the security increase in price. And similarly, it's a kind of market if touch order. So once the market will touch 60, your order will become a market order, and then in the queue it will be executed. So you may not get, your stock may not be purchased at a price of 60. It can be 61, it can be 59 even, depending, because at 60 it will trigger, it will become active. Margin transaction. Margin transaction is on any type of order, instead of paying the 100% cash, mean the 100% amount that you pay from your own pocket, you borrow a portion of it, of the transaction, using your stocks as a collateral. So from the broker, from the you can borrow a portion of it. So you purchase stocks worth of, let's say, 50,000 rupees. Out of those 50,000 you pay, let's say, 30,000. It means 60% you pay in the form of cash and the 20,000 you borrow. So then this transaction is known as a margin transaction, where your margin is 60% while 40% you borrow. That is what you call as. But remember, when you borrow the 20,000, your stocks will be with the broker. So the broker will hold the stocks. You pay 30,000 out of it, and the 20,000 is borrowed. There are regulation to limit the proportion of the amount that you can borrow. Generally, the limit on this is that the initial margin requirement are 50% or more than 50%. But remember, it can vary from one stock exchange to another stock exchange, and there may be certain brokers who may not allow you any margin at all. Changes in price affect the investor equity, mean in the initially you were having 60% of your own equity and 40% were the borrowing amount. In 50,000, if you borrow 30,000, so it means 60%, sorry, 20,000 you borrow, so it means 40% is debt or borrowing, and the remaining 60% was your equity. But once the price will change, so then your equity portion can increase or it can decrease, and how it affects, we'll see it in this slide. Just an example, that you purchase 500 shares of a company when its price was 20. So 500 shares, the price 20, so the total value is 10,000. Let's say your margin requirement is 50%, so and you borrow 50%. So 50% you borrow out of 10,000, so it means 5,000 is your borrowing and your investment is of 5,000. Now if the price increases to 24, so 500 multiply by 24, so it means the current value of your these stocks is 12,000. Out of this, 5,000 was the borrowing. So if you subtract 12,000 minus 5,000, so it means you will get 7,000. So 7,000 is your equity. So your initial margin was 50%, but now how much is your margin? The 7,000 your equity divided by the total value of the stock, the current value of the stock, that is 12,000. So the answer that you will get is 58.33%. So it means once the price increases from 20 to 24, your margin increases from 50% to 58.33%. Now take the second example, that let's say you purchase the same 500 shares and at a price of 20, so the value is 10,000, your margin is 50% and 50% is borrowing. But let's suppose if the price dropped down to 16, so the current worth of the shares will be 500 into 16 is equal to 8,000. Out of this, 5,000 is your borrowing, so it means your current equity is 3,000. So what is the percentage of your equity now? 3,000 divided by 8,000, and it is 37.5%. So your initial equity was 50%, but now it has dropped down to 37.5%. So when the price decreases, the portion of your equity reduces, and when price increases, just like in the previous slide, your equity portion has increased. Then there is question arises that maintenance margin, that brokers will ask you to have minimum margin, that below this your margin should not drop down. That is what you call as the maintenance margin. It's a requirement proportion of equity to stock. Just like in the previous case, the equity has dropped down to 37.5%. If the price further drops down from, let's say, from 16 rupees per share, it dropped down further to, let's say, 15 or 14 or 12 rupees, your portion of equity will further drop down. So when there is a maintenance margin, so the maintenance margin actually protects the broker if the stock prices fall down. Now theoretically speaking, if in the previous slide, just let me show it again. Here, if the price of the stock drop down further from 16, let's say if it dropped down to 12 rupees per share, so then how much will be the value? 500 multiplied by 12, it will be only 6,000. Out of 6,000, there are 5,000 rupees borrowed, so it means there will be only 1,000 of your equity. So your portion of equity will be 1,000 divided by 6,000. So it means your equity portion will further drop down from 37% to probably around 20% or even less than that. Now theoretically speaking, if the price falls below 10, let's say it become 8 rupees per share, so 500 shares you purchased and now the price is 8 rupees, so the total worth of your equity will be only 4,000 rupees. 8 rupees per share into 500, so total worth is 4,000, and if you have a borrowed amount of 5,000, it means your equity will become negative. In that case, there is a chance that the investor, you will default, that I'm not going to pay the 1,000. In that case, the broker can incur losses. For that very reason, there is a minimum maintenance margin. Now let's go to this slide and you will understand. So there is a minimum margin, that if your margin drop down to that level, you will receive a margin call, that you need to deposit additional money, otherwise the broker will sell you a stock. So that minimum margin is generally 25% or above. The margin call and under margin accounts to meet the margin requirement. So if your margin falls below 25%, let's say if your maintenance margin is 25%, so whenever your margin level will reduce below 25%, you will receive a margin call. And if you, as an investor, if you don't respond to it, don't deposit additional money, the broker can sell your stocks. If margin call not met by the investor, stocks will be sold to pay off the loan and the accrued interest. Let's say, so whatever is the loan, the 5,000 that you have got, and let's say if there will be some interest, so the broker will recover the amount of lending and then the interest, and if there is any remaining amount, you will get that. How we calculate the margin? So the on any account, if you want to determine your current margin, the current margin can be calculated by the current price, whatever is the current price, multiply by the number of shares and minus the borrowings that you have, divided by the current price into the number of shares. Now it is the same thing that we determine the margin, the current price multiplied by the number of shares minus the borrowing. So that was your equity, and equity divided by the current value of the investment, that will become your current margin. So we have an example here. Let's say you purchase 500 shares of OGDCL at a price of rupees 125. Remember, OGDCL is currently trading at a price of 103 and 105 range, but we take the example of 125 with an initial margin of 60%. What is your current margin if OGDCL stock is currently trading at a price of 140? That is one example. And if the price is 115, so I have solved the question for the 140, and for the 115 you will solve it. So let's do it quickly. This is how solution, that the purchase value is 125 into 500, so the total purchase value is 62,500. Let's say if the initial margin is 60%, so the initial equity will be the purchase value, that is 62,500 multiplied by 60%, that is 0.6. So it means your initial equity is 37,500. So borrowing will be how much? From 62,500 total value, 36,500 is your equity, so the remaining is your borrowing, and that is 25,000. So if the price increases to 140, so then the current value will be 140 multiplied by 500 minus borrowing. Now remember that this is the formula that we are actually talking about. So the current price is 140, that this price we have taken, multiply by the number of shares, that is 500, minus the borrowing that we have calculated here, that is 25,000, divided by the current price, that is 140 into 500, that is the value. So what we will get is, we get 70,000 minus 25,000 divided by 70,000. So 70,000 minus 25,000 is 45,000, divided by 70,000, it is 0.6429, or it is equal to 68.29%. So your initial margin was 60%, but now your margin has increased to 64.29%. Why? Because the price has increased from 125 to 140. So when the price will increase, your margin will increase, your percentage of your equity will increase. On the other hand, when the price will reduce, that is, let's say to 115, your margin will reduce, and that you have to calculate. Remember, the hint is that it will be 56.52%, so you can verify it. Now, as I told you that the information technology has brought a lot of changes in the stock trading, so there are electronic systems through which actually transactions take place these days. So now individuals are not making the buying and selling as it used to be, you know, 40 or 50 or 100 years ago. So now it is actually electronic, in an electronic way that we are doing. So electronic order routing system. So in Karachi Stock Exchange we have, so, you know, the Karachi automated trading system, that is CATS, and it's member firms and investor transmit, market and limit orders in the Pakistan Stock Exchange. So you know, you can do it yourself as an investor. Obviously you need to have a broker account, but on online trading you can do it yourself. It report of execution return electronically, so when your order will be executed you will be informed that your order has been executed. So it is now being done electronically, and that is Karachi automated trading system, which facilitate trading for stock brokers. And obviously when you give order to your broker, your broker will put that order into that system and the system will execute it automatically. But now a step further, that it is the Karachi internet trading system that the investors themselves can trade. They can put the order on their mobile phone, on their, you know, computer, laptops. So this system is an online system of trading where investors can trade themselves. Remember, you need to have an account with a broker, but you don't need the services of broker to enter the order. You can do it yourself. And obviously for the bonds market there is a bond automated trading system, but in Pakistan we don't have a very huge bond market. Now just to you know, based on the questions that you have at the end of this chapter, based on that I have, that how you will determine the profit or how you will determine the, you know, the rate of return, uh, keeping in view those questions. So the first is that if you ignore the commission and dividend and interest on borrowings, if any, you know, if you borrow a certain amount and you ignore the interest that you will pay, so how you can determine the profit or loss? It's very simple. The sale value minus the purchase value. So you can determine your, you know, profit or loss. How you can determine the sale value? Sale price multiplied by the number of shares, so that will be your sale value, minus purchase price into the number of shares, so that is the purchase value. So sale price you need to know, the number of shares, and then the purchase price and the number of shares. N represents the number of shares. So this is how you can determine the profit or loss. And how you can determine the rate of return? So the rate of return will be equal to the profit or loss that you have calculated here, and then divided by your initial investment multiply by 100, so to convert it into percentage. Now if you purchased on cash, mean 100% cash, you did not use any margin, then your initial investment is equal to the purchase value, because you have paid everything from your own pocket and you did not borrow anything. So then your purchase value is actually equal to your initial investment, because we don't take commission here or any other thing. So it means your equity is equal to the purchase value. While if you have used the margin transaction, so then your initial investment is equal to your purchase value minus borrowings. So whatever is the purchase value, you will subtract the borrowing from it, so the remaining amount will be your equity, and that equity is your initial investment. So here we calculate, mean how you can calculate borrowings. Borrowing is equal to your purchase value minus equity. But again, that how much is my equity? So your equity is equal to the purchase value multiplied by the initial margin required. So let's say you purchase stock worth 50,000 as we mentioned earlier, and your margin requirement is 60%. So 50,000 into 0.6 you will get 30,000. So 30,000 is your equity. So your equity will be 30,000. Your purchase value was 50,000. So 50,000 minus 30,000, you will get the borrowings. So the purchase value, that is 50,000 minus borrowing of 20,000. So you will get your equity. And that equity, since there is no commission or anything else, that purchase value, that equity is your initial investment. So these equation can be rearranged to calculate the missing value. So you know, any missing value you can calculate, you can rearrange these equations. The next is that if we don't ignore the commission and the dividends and interest, so then how can we determine the profit or loss? So then the profit or loss can be calculated by, I use the shortcut for it. These are not universal shortcuts, so don't confuse it. That it is sale value minus purchase value minus purchase commission. Now purchase commission can be in the form of like total amount, that let's say 200 rupees of commission, or it can be a percentage of the purchase value, let's say 1% commission or 2% commission. So then you can overall purchase value multiply by that percentage and you will get the purchase commission. Similarly, minus sale commission minus interest and plus dividend income. In case you purchase the stock and you hold it till, let's say, for a month or a 2 month or 3 month, and during this time period you receive certain amount of dividend. So dividend can be given per share, that on each one share the dividend is, let's say, 2 rupees. So whatever number of shares you have, you multiply by that, so you will get the dividend income. So this is how you can calculate your profit or loss. And once you will be able to calculate the profit or loss, then you can calculate the rate of return as well. So here I have explained it, that PC mean and SC mean that these are purchase commission and sale commission, I mean interest expense, DI is the dividend income. So the rate of return again is the profit or loss that you have divided by the initial investment, multiply by 100 to get it in percentage form. But here the initial investment will now be a bit different, that if purchase on 100% cash, then the initial investment is equal to the purchase value plus the purchase commission. So you will add the purchase commission, because the purchase commission you will pay at the time of purchase. So that is also a kind of investment, because you want to have a return on that as well, because you pay earlier and then you wait for it, let's say for 2 months or 3 months. While in a margin transaction it will be equal to the purchase value minus borrowing, because this will actually give you the equity and then plus the purchase commission, so you will get your initial investment. So once you will practice it, you will be able to understand it. Now remember, for a short sale it's a bit different. For a short sale it's a bit different, because in a short sale the dividends will not be plus, rather it will be subtracted, because if you short sale the security and the company has paid dividends, so then you will pay the dividend, as we explained earlier that when we were explaining the short sale. So in that case the profit or loss will be equal to the short sale value minus the repurchase value, once you will repurchase the stock, minus the short sale commission mean the commission that you pay at the time of short sale, minus the repurchase commission mean once you repurchase the stock at that time, whatever commission you will pay, and then minus the dividend income. So the dividend will not be added, it will be subtracted. So this is how you will determine your profit or loss. And then obviously the rate of return will be equal to your profit or loss calculated here and divided by the initial investment. And here the initial investment will be equal to what? Initial investment is equal to the margin deposited, because as we discussed earlier that even in a short sale you will be required to deposit a margin. So the margin deposited, the amount, the rupees amount, the dollar amount, plus the commission at the time of short sale, these two will be added and that will become your initial investment. So again you need to practice it and then you will understand it. With this we end of this chapter. The problems I will solve in a Excel sheet and I will share separately for the time being the theoretical part of it and some of the formulas that you can use yourself to solve the questions or the problems of this chapter. I have discussed it here. Thank you so much.